Let me ask you something honest. How many bank accounts do you have right now? One? Maybe two? And do you even know what each one is actually doing for you? Or is it all just sitting in one place, getting spent a little at a time, until your paycheck disappears and you wonder where it all went? Here's the truth that most people never figure out until it's too late. It's not just about how much money you make, it's about how well you organize the money you already have. And the single most powerful organizing tool available to ordinary people, one that requires no special degree, no financial advisor, and no large income, is the strategic use of multiple bank accounts, each designed to serve a specific purpose in your financial life. Today, we're going to walk through 7 accounts that most individuals and families should have in place, not because you need to complicate your finances, but because without this structure, you're essentially playing a game without rules. You're spending from the same pool that's supposed to cover emergencies, fund your children's education, build your retirement, and protect your household. When everything is in one place, everything competes for the same dollar, and the loudest, most immediate need always wins. The future always loses. By the end of this video, you'll understand not just what these accounts are, but why they work, how they change your behavior, and what happens to people who never set them up. Stay with me. Before we get into the specific accounts, let's talk about why this matters at all. Why can't you just keep everything in one checking account and use willpower to manage your spending? The honest answer is, because willpower doesn't work for money. Not consistently, and not long-term. This isn't a character flaw, it's behavioral economics. Studies have consistently shown that people spend money based on what they perceive to be available. If you see $2,000 in your account, your brain interprets $2,000 as what you have to spend. Even if $800 of that is quietly owed to next month's rent, $300 was supposed to go toward a car repair you've been delaying, and another $500 was earmarked for your child's school supplies. Your brain sees $2,000, and you feel financially comfortable. Then something small happens, a dinner out, a weekend trip, a sale that felt too good to pass up. And suddenly the rent money, the car repair money, and the school supply money are all gone, replaced by a vague feeling of financial anxiety you can't quite name. This is not a spending problem, it's a visibility problem. When you have separate accounts for separate purposes, each account tells you a precise story. Your emergency fund account says, this money exists to protect you. Don't touch it unless something goes wrong. Your vacation fund says, this is fun money accumulating for a specific reward. Your 529 plan says, this is your child's future. It's already gone. That's the psychological shift that separate accounts create. And that shift is worth more than any budget spreadsheet you could ever make. Now let's go through each of the 7 accounts you need, one at a time. The first account is one almost everyone already has, a checking account. But the way most people use it is the source of their financial disorganization. They treat it as their everything account. Paycheck goes in, bills come out, groceries come out, coffee comes out, entertainment comes out. And somewhere in there, whatever's left is technically their savings. Except they always seem to spend that too. The right way to use a checking account is to treat it as a clearinghouse, not a storage unit. Your paycheck should arrive here. Your fixed monthly bills should be paid from here. And that's it. Everything else, your savings contributions, your investment transfers, your emergency fund deposits, should leave this account automatically on payday before you have a chance to spend any of it. This is the power of automation, not because you're lazy or undisciplined, but because every financial decision you remove from your daily willpower is one more decision that goes the right way. The best financial systems run in the background. You set them up once, and they execute every month regardless of how tired you are, how stressed you feel, or how many sales are happening at your favorite store. Your checking account should ideally hold just enough to cover 1 month's worth of fixed expenses, perhaps a small buffer of a few $100s on top of that, and nothing more. If you consistently have too much sitting in your checking account, it's a sign you're not moving money to the accounts where it can actually work for you. The second account is one of the most underused tools in personal finance, a high-yield savings account. And if you still have your savings sitting in a traditional bank savings account, earning the standard 0.01% annual interest, you are quietly losing money to inflation every single year without realizing it. Let's make this real. Imagine you have $5,000 saved in a traditional bank savings account paying 0.01% annual interest. After 1 year, you've earned 50 cents, not $50, 50 cents. Meanwhile, inflation is quietly eroding the purchasing power of that $5,000 by roughly 2 to 3% per year. That means in terms of real value, your savings are actually shrinking, even as the number in your account technically stays the same. Now contrast that with a high-yield savings account. Many online banks and credit unions offer annual percentage yields of 4, 4.5, even 5% at various points in time. On that same $5,000, you'd earn somewhere between $200 and $250 per year. That's the difference between working at a grocery store checkout for an hour or earning nothing at all. Now, that might not sound like life-changing money, but this account isn't just about interest. It's about the behavioral principle of separation. Your high-yield savings account should hold your short to medium-term savings goals, things you're saving for within the next 1 to 5 years. A down payment on a home, a new car purchase, a major home renovation, a wedding, a career sabbatical. These are goals that are too close in time to invest in the stock market, where they could lose 30% of their value right before you need them. But they're too important to leave sitting in a checking account, where they'll be spent. The high-yield savings account creates a kind of psychological friction. It's not immediately accessible the way your checking account is. Transfers typically take 1 to 3 business days to hit your checking account. That small delay is actually a feature, not a bug. It gives you time to reconsider whether you actually need to make that withdrawal. And more often than not, the answer is no. The third account is the emergency fund. And this one is arguably the most important of all, because it is the account that protects every other account from being destroyed. Here's what happens without an emergency fund. You're doing well. You've been saving consistently. You have a few $1,000s in your high-yield savings working toward a house down payment. You're making retirement contributions. And then your car engine fails, or your furnace stops working in January, or you lose your job. And because you have no dedicated emergency fund, you raid your savings. You withdraw money from your retirement account and pay a penalty and taxes on it. You put the expense on a credit card and pay 20 to 25% interest for the next 18 months. One unexpected event, and it doesn't even have to be a catastrophic one, dismantles months or years of financial progress in a single weekend. The emergency fund exists specifically to prevent this cascade. The general guidance from financial educators is to keep 3 to 6 months of essential living expenses in a dedicated savings account that you do not touch for anything other than a genuine emergency. Not a sale, not a vacation, not a gift, a genuine emergency, job loss, medical crisis, major unplanned repair. For someone whose monthly essential expenses total $3,000, that means having $9,000 to $18,000 sitting in this account at all times. That might feel like an impossibly large number if you're starting from zero, but the path there is simple. Automate a fixed amount, even $50 per paycheck, into this account every month, and don't touch it. Within a year or two, the account will be where it needs to be. And once it's there, the psychological relief is remarkable. People who have a fully funded emergency fund report significantly lower financial anxiety than those who don't. Not because their income is higher, but because they have a buffer between their life and financial disaster. The emergency fund should be in a separate savings account, not your everyday checking, not invested in stocks, not in a certificate of deposit that penalizes early withdrawal. It needs to be liquid, accessible within 1 to 2 business days, and boring. That's the whole point. The best emergency fund is the one you forget about until the day you desperately need it. The fourth account is the one most people know they should have, but either delay starting, contribute too little to, or misunderstand entirely: the retirement account. Whether it's a 401(k) offered by your employer, an IRA you open independently, or a Roth IRA for tax-free growth, the retirement account is the vehicle that converts your working years into financial security for the decades when you can no longer wish to work. And here is the devastating truth about delay. Every year you wait to start investing for retirement costs, you far more than you realize. Not because of the dollars you miss out on contributing, but because of the compounding growth those dollars would have generated over time. Let's look at 2 people. Person A starts investing $500 per month at age 25. Person B waits until age 35 to start investing the same $500 per month. Both invest until age 65. Assuming an average annual return of 7%, Person A ends up with approximately $1.2 million. Person B ends up with approximately $600,000. Same monthly contribution, same rate of return. The only difference is 10 years. Person B contributed $60,000 less in total, but their ending account balance is roughly half. That's what compounding does. And it's also why starting early, even with small amounts, is almost always more powerful than starting later with larger amounts. The behavior pattern that undermines retirement savings most commonly is not neglect. It's treating the retirement account as an emergency fund backup. When people hit financial difficulties, they withdraw from their 401(k) early, triggering both income taxes on the withdrawn amount and a 10% early withdrawal penalty. This is one of the most expensive mistakes in personal finance, because you're not just losing the money, you're losing all the future growth that money would have generated, taxed at your highest marginal rate, and then penalized on top of that. This is exactly why the emergency fund in the previous section must be funded before this happens. The two accounts protect each other. The emergency fund absorbs life's shocks. The retirement account is left alone to compound. If your employer offers a 401k match, where they match your contributions up to a certain percentage of your salary, that match is the closest thing to free money that exists in the financial world. Contribute at minimum enough to capture the full employer match. Not doing so is leaving a portion of your salary on the table every single paycheck. The fifth account is the taxable brokerage account, sometimes called a general investment account, and this is where your long-term wealth beyond retirement begins to be built. You might ask, why do I need a brokerage account if I already have a 401k or IRA? The answer comes down to flexibility and limits. Retirement accounts like IRAs and 401ks have annual contribution limits set by the IRS. Once you've maxed out your retirement contributions for the year, a brokerage account is where additional investing happens. And, unlike a retirement account, there's no age restriction on when you can access money in a brokerage account. You can invest and withdraw freely, which makes it the right vehicle for financial goals that are more than 5 years away, but not specifically tied to retirement. Things like funding a future business, building generational wealth, or achieving financial independence before traditional retirement age. The key principle for a brokerage account is long-term patient investing. Not trading, not timing the market, not chasing the latest hot stock or cryptocurrency. Decades of data from financial research show consistently that the vast majority of active traders, including professional fund managers, fail to beat simple, low-cost index fund investing over long time periods. The strategy that has made ordinary people wealthy consistently over decades is straightforward. Invest regularly into broadly diversified, low-cost index funds and leave the money alone for as long as possible. What destroys wealth in brokerage accounts is emotional decision-making. Markets go down, sometimes dramatically. Investors who panic and sell during downturns lock in their losses and often miss the recovery. Investors who stay the course, continue contributing, and resist the urge to react to short-term volatility are the ones whose accounts look dramatically different 15, 20, 25 years later. The brokerage account rewards patience above all other qualities. Not intelligence, not timing, not insider knowledge, just patience. The sixth account is one that very few people have heard of by name, but once you understand it, you'll wonder how you ever managed without it. It's called a sinking fund, and it is the account that eliminates the financial pain of predictable expenses. Here's the problem it solves. Every single year, that December is coming. There are holidays. There are gifts to buy, travel to pay for, family dinners to host. And yet somehow, every December, these expenses feel like a surprise. Why? Because you spent the money throughout the year without setting anything aside for expenses you could see coming from 12 months away. And the result is either credit card debt carried into the new year or money borrowed from savings that never quite gets repaid. The same thing happens with car maintenance, with property taxes, with annual insurance premiums, with back-to-school shopping. All of these are perfectly predictable expenses that hit people like emergencies because they were never planned for in advance. A sinking fund is a savings account. You can have multiple sub-accounts if your bank allows it, where you set aside a fixed amount each month toward known future expenses. If you know you'll spend $1,200 on holiday gifts and travel in December, you need to save $100 per month starting in January. By December, the money is there. The expense isn't a crisis. It doesn't require debt. It doesn't destabilize your monthly budget. It's just a transfer from the account you built specifically for this purpose. The sinking fund fundamentally changes how you relate to irregular expenses. Instead of dreading them, you start anticipating them with neutrality, maybe even satisfaction, because you've been preparing. This is one of the quietest but most powerful shifts in financial behavior a person can make. It converts what feel like emergencies into planned events. The seventh account is one that is particularly important for parents, but can benefit anyone saving for education, their own or someone else's. It's called a 529 plan, named after Section 529 of the Internal Revenue Code, which governs how these accounts work. A 529 plan is a tax-advantaged savings and investment account designed specifically for education expenses. You contribute money after tax, it grows free from federal taxes, and when you withdraw it for qualified education expenses, those withdrawals are also tax-free. This combination of tax-free growth and tax-free withdrawal makes it one of the most efficient savings vehicles available to families. The qualified expenses are broader than many people realize. They include tuition, room and board, books, required fees, and equipment. At most accredited colleges, universities, graduate schools, vocational schools, and even many international institutions. Starting in 2018, the rules were expanded to allow up to $10,000 per year of 529 funds to be used for tuition at public or private K-12 schools as well. This means 529 plans are no longer just for college. They can help with private elementary or high school tuition too. There's no income limit to contribute to a 529. There's no age limit on the account beneficiary. There's no annual contribution limit set by the IRS, though individual plans may impose lifetime limits. And those limits are typically very generous, often exceeding $300,000 per beneficiary. Another significant advantage: qualified 529 withdrawals are not counted as student income in federal financial aid calculations, meaning they don't reduce your child's eligibility for need-based aid. Most states offer at least one 529 plan, and many states provide a state income tax deduction or credit for contributions made to their home state plan. This is essentially free money, a tax break on top of the tax-free growth the account already provides. If your state offers this deduction, it's a strong reason to use your state's plan, at least in part. Now, here's something important to understand about 529 accounts. The money belongs to the account owner, not the student, and can have only one designated beneficiary at a time. Each child in your family needs their own separate 529 account. However, if your first child earns a full scholarship and doesn't need all the funds, you can change the beneficiary to another family member in the same generation without tax consequences. This flexibility makes 529 plans far more versatile than many people assume. The one meaningful risk is this: if you withdraw 529 funds for non-qualified expenses, you'll owe income tax on the earnings portion of the withdrawal, plus a 10% penalty. So it's wise to be conservative in estimating how much you'll actually need for education costs, and to not overfund the account beyond what you reasonably expect to spend. The most powerful thing you can understand about a 529 plan is the same principle that governs every investment account. Time is the most valuable resource you have. A family that starts contributing $200 per month to a 529 plan when their child is born will accumulate far more by the time that child turns 18 than a family that contributes the same amount starting when the child is 10. The math is simply a function of how long that money has to grow. Whether you can afford $10 a month or $1,000 a month, starting today is always better than starting tomorrow. Let's take a step back and look at the complete picture. 7 accounts, each one doing a different job, each one representing a different time horizon and a different life priority. Your checking account is the clearinghouse. Money flows through it, not into it for long. Your high-yield savings account is for medium-term goals, 1 to 5 years out. Your emergency fund is your financial immune system. 3 to 6 months of essential expenses, never touched unless it's a real emergency. Your retirement account is your future self's paycheck, automated, invested consistently, left to compound. Your brokerage account is your long-term wealth builder beyond retirement, patient, broadly diversified, immune to emotional decisions. Your sinking fund is your predictable expense manager, eliminating financial surprises by planning 12 months in advance. And your 529 plan is your investment in the next generation's human capital, or your own if you're returning to school. Together, these 7 accounts don't just organize your money. They organize your behavior. They reduce decision fatigue. They eliminate the emotional randomness that causes most financial mistakes. They make certain outcomes, an emergency fund, a retirement, an education, a vacation, feel inevitable rather than aspirational. The most common objection people raise is, I don't have enough money to do all of this at once. And that's a completely valid starting point. You don't have to build all 7 accounts simultaneously. You build them in order of priority. First, get the emergency fund started. Then make sure you're contributing enough to your retirement account to capture any employer match. Then open the high-yield savings account for your next major goal. Then the 529 if you have children. Then the sinking fund for predictable future expenses. And finally, the brokerage account when you have additional income to invest beyond your retirement contributions. Each account you add strengthens the whole system. Each layer of financial structure makes you more resilient, more clear-headed, and less reactive to the financial pressures that derail people who never set this up. The fundamental insight of everything we've discussed today is this: financial success is not primarily a matter of income. It's a matter of structure. The person who earns $50,000 a year and organizes it deliberately will often end up in a stronger financial position than someone who earns twice as much but manages it casually. You don't need to be wealthy to start. You need to start to build wealth. Open one new account this week. Automate one small transfer. Make one financial decision that your future self will thank you for. The system works, but it only works if you build it. If this video gave you a clearer picture of how to structure your financial life, please consider sharing it with someone who could benefit. Leave a comment below telling me which of these 7 accounts you're setting up first. I read every single one. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Please consult a qualified financial professional before making any investment or financial decisions specific to your personal situation.